It's Quadruple Witching Day for September. This month, 40% of all S&P 500 options will expire, or roughly $800 billion. And if that isn't enough to create volatility, we have S&P rebalancing after the market close. Randy Frederick, Director of Trading and Derivatives for Schwab, is finding it hard to remain optimistic.
Yeah, that's right, Deborah. I tell you, it's an interesting thing. We've had a couple of pretty solid up days, both yesterday and today, and it's really a good time for that to occur, actually, because it is expiration week. A lot of people roll out positions to subsequent months, and when you get a nice upside move just before expiration, it allows you to close out your front month options at a relatively low price. But because volatility remains elevated, well above 30% for over a month now, the later month options that they're rolling out to are still paying a very nice premium. And I'm talking about people rolling out short options like covered calls. For those who still have a somewhat optimistic view long term, is to put on a very protective position. And the one I've been talking a lot about lately is a collar strategy. Collar strategy is a way where you can protect the downside of your position by giving up some upside. The nice thing about the collar, and the reason I like it, and it even works in a situation like we're in now where you may even have a stock that's down a little, is that if the stock continues to go lower, you have the choice of either using the put to get rid of the stock at a better price once it's dropped below the put, or you have the choice of selling the put and taking the profits from the put to offset a portion of the stock and then hang on to the stock. So it's nice that you have that choice. If the stock turns around and starts to rebound and the call ends up in the money, as you get close to expiration date, and typically that would be on usually Wednesday or Thursday of expiration, so like yesterday and today, then you close out that position and roll out to the next month. And then you postpone that expiration for an extra month, and in doing so, you get paid extra money. So you can actually maintain your positions and slowly erode away your cost basis, or I shouldn't say erode away, but I guess slowly lower your cost basis over time, regardless of which direction the stock goes, by having that downside protection but bringing in income on the top side.